In this video, I will talk about how to increase your FICO score and build an exceptional credit history. My current FICO credit score stands at 825, which is not perfect, but very close to the max score of 850. I used several strategies to get this high score over the years that I will share with you here. Getting a high FICO score is a game. If you know the rules of the game and play by them, there's a high chance of you getting an exceptional FICO score too. So let's understand FICO first. FICO stands for Fair Isaac Corporation Score. Developed in 1956, FICO is a staple among mortgage, car and credit card companies. The score ranges from 0 to 850 and is a composite of the following 5 factors according to FICO itself. We see that payment history and amounts owed account for 65% of FICO score. In other words, it pays most to focus on these 2 areas to get the most results. The other 3 factors, such as new credit, length of credit history, and credit mix, also play a role, but their weights are much smaller. Lenders consider a score below 550 as poor. People with a score will have a hard time qualifying for anything, and if they do, they will face astronomically high interest rates. The second tier is from 580 to 669 and is considered fair. It is below the national average of 717 in 2024. If you are in this tier, it is best to work hard to graduate from it as fast as you can. The next tier is from 670 to 739. This tier encompasses the national average of 717. Most lenders will qualify you for credit at acceptable terms with that score, but where things get bumped up to a whole new level is with very good and exceptional levels. Many more opportunities open up for you and your interest rates will be much lower. Let me show you some benefits of improving your credit score. They may or may not be important to you. You may have a hard time qualifying for certain prestigious credit cards. For instance, Chase Sapphire cards require a FICO score above 720. Also, according to FINRA in 2015, a credit score between 620 and 639 would qualify you for roughly 4.9% on a 30-year fixed mortgage. But a score above 760 would give you a 3.3% interest rate. That's over 1.5% difference. A mortgage at 7% requires cumulative interest of $460,000 over 30 years. Conversely, having 8.5 interest rate results in $583,000 cumulative interest. That's a $123K difference over 30 years. Imagine what you can do with that much money. Save, invest, pay for kids' education, and so on. Let's focus on the first most important factor, which is payment history. It accounts for 35% of your FICO score. Credit cards have the so-called minimum payments, and they are typically some fixed percentage of your balance or some minimum amount, and the percentage varies from 1 to 2%. So if you pay minimum payments that the credit cards require you, you will avoid late charges as well as penalty interest. But even making this minimum payment, you will still be charged interest, which is notoriously high for credit cards. So the rule of thumb advice is to pay off your previous month credit card statement balance to avoid interest altogether. Some people recommend setting up automatic payments, and that way you will not forget to pay off your bills for credit cards or something else. While it's a good advice, you still must know your checking account balance and make sure that it's sufficient for that to work. What I have been doing over the years is different. I have a simple spreadsheet where I keep track of all my required payments. Credit cards, utility bills, tax prepayments, rent, etc. go there. Next, I set up my due dates on all my credit cards and bill payments on the 5th of the month, if possible. On the first day of the month, I open up my spreadsheet and knock out each bill payment one by one. I also review all my charges to spot anything unusual or fraudulent. At the end, I tally all my payments and compare them to my checking account balance. If the balance is sufficient, I transfer excess funds elsewhere to earn investment income. If not, I transfer funds from my savings account to my checking to make up for any shortfall. Another ancillary thing that you can achieve with this approach is to calculate your net worth. Of course, there are budget apps that can do that for you, but I personally prefer the good old manual way. So what I do, I list all my checking, savings accounts, any investments or brokerage accounts, and then I subtract all the debt balances on that particular day, and that way I get net worth. So net worth is just your assets minus liabilities. The net worth number lets you know how you progress on a wealth accumulation path. Paying off your previous month balance is good, but paying off your current entire balance on your credit cards is even better. Why is that? It is because the utilization rates for your lines of credit matter for FICO. Let's say you have many cards. One card gave you 10,000 credit limit. The common sense approach is to keep your credit utilization rate under 30%. In other words, don't let your billing cycle close on that card with over $3,000 in charges. Having more than 30% utilization will almost surely result in FICO score decreases, and it is important to hit this magic utilization rate of 30% before your billing cycle closes. As a rule, lenders report credit balances to credit bureaus a few days before billing cycle dates. Some people say that you must go even further. You should keep your aggregate credit utilization under 10%. Actually, this is what I did over these years. I have kept my credit utilization rates under 10% for all my credit cards. This inadvertently results in an aggregate utilization rate under 10% too. Paying the entire current balance on my credit cards each month was the best approach for that. Of course, it doesn't mean I wouldn't have any balances at all, because I may have had some expenses after my payments and before the billing cycle ends, so all those expenses would show up on my credit reports. I can't say I was, perfect with that though. Sometimes I would have a large expense, like maybe airline ticket or something like that, after I paid off my balance each month, and so that would show up on my credit report, and maybe it would be above 30% utilization rate for a specific card and would maybe lower my FICO score. But again, this was rather an exception than a rule. Ideally, I should not have paid off everything to zero to maximize my FICO score. I should have kept small balances at around 1 to 2% utilization on each card. I think this is the best score maximizing strategy. However, realistically, I didn't do it as it is too much hassle for me. But I want to throw it out there as it may help you maximize your FICO score. Also, I made some mistakes over the years with credit utilization. For instance, if you go to say Macy's or other stores, they may offer you store credit for large purchases. For instance, I once bought a bed on a new store credit account. My mistake was to let the salesperson open an account without specifying a credit limit. They opened it with a credit line that matched my bed price. The problem was my credit utilization on that account was close to 100%, which was not good for FICO. But the good news is that this decrease was temporary. Once I paid off that card, the score went back up. So I should have asked for a higher credit limit then to keep my utilization with that purchase below 30%. Here's another strategy that I use to keep my utilizations rates down. I regularly contact credit card companies and ask them to increase my credit limit. And if your income stays flat, even with that, you can get credit limit increases, but if it grows, there's a higher chance of getting them. And increasing credit limits put me at a much lower risk of exceeding that magic 30% utilization rate. And here's another important thing to keep in mind. You may have many credit cards. Sometimes, you don't use all of them. So here's the problem. If you don't use credit accounts for more than a year, the account goes dormant. It could be more than a year for some lenders. With that, two things can happen. One, your credit card company may slash your credit limit. That has actually happened to me in the past. Or Or worse, it can close your account without any prior notice. That has happened to me too. In that case, your aggregate utilization rate may go up. Also, if that's your longest held credit account, your credit history length may get shorter. So what we do is we keep tabs on our cards that we do not use often. If we are approaching a year with no use, we put a small charge on it so it doesn't go dormant and catches bank's attention. Let's talk about other strategies that I use. One of them is avoiding too many credit checks within a specified period of time. Typically, if you have 2 or less credit checks within a 2-year window, your FICO doesn't go down too much. But if you have 3 or 4 or more, and if they are done in a quick succession, then the FICO score may start going down faster. So my personal rule of thumb is to avoid having 2 or more credit checks within a 2-year period. One thing to keep in mind is that credit checks for mortgages within a certain period of time count as one inquiry. According to the Consumer Financial Protection Bureau, this period is 45 days. Another factor for FICO is credit mix. And having different types of loans will help you build your credit score. For instance, car loans, mortgages, student loan, credit card debt will help you to further maximize your FICO score. But I won't go into that just for that, The thing is, I was able to build this exceptional FICO score on credit card debt alone. So I would say that credit mix is less of an important factor for FICO as it accounts for only 10% for it. Finally, credit history length matters. The longer it is with no missed payments and delinquencies, the better your score may get. So I'm careful with closing old credit cards unless there are compelling reasons for doing that. I prefer putting small charges and keeping them going. This way my credit history length will not get shortened. There are other best practices that I follow to keep my FICO high. Specifically, I order a free credit report from one of the 3 credit bureaus. By law, they are required to provide us a free credit report each year. So technically, we can get 3 of them annually. There, I look for any suspicious activity or inaccuracies. So far, it hasn't happened to me, but it doesn't mean it cannot. And I am always on the lookout for identity theft or fake accounts. So if I notice anything that I don't recognize on those credit reports, I would file a report and dispute it with Equifax, TransUnion, or Experian. So all these strategies work if you have a steady stream of income and can pay off your credit regularly. But what if you're someone who lost a job or is facing mounting medical expenses? These are tough situations and can put anyone on a quick path to financial ruin. FICO can go down quickly. If you feel like you're about to start missing payments, here's what to do. Reach out to your creditors and see if you can work out a plan to delay your payments. Some banks may offer credit card hardship programs. It is a negotiated payment plan that may waive fees and lower interest rate for a short-term period. Usually it could be 3 months or longer depending on the bank. To qualify, you must show that you are facing financial hardship. Situations like loss of employment or natural disaster will qualify you. I will have a video on hardship programs and other strategies to avoid financial ruin shortly. Stay tuned and subscribe to my channel for that. Why do that? The thing is that FICO can decline big time otherwise. And if it comes to worse, you can go bankrupt, and bankruptcies alone can lower FICO score anywhere from 130 to 250 points at a time. And bankruptcies, depending on the type, they will remain on your credit history anywhere from 7 to 10 years. And during those times, the borrower remains pretty much untouchable by creditors. And it will take years for the credit history to get clean again. Another thing is that what if you're someone with no credit history? In that case, there are several strategies too that you can use, and I use personally myself to build my credit history from scratch. First, you can get a secured credit card. For that, a bank requires a savings account where you must keep a certain amount of funds. This money serves as collateral for your line of credit. The bank will allow you to use your credit card up to a certain percentage of your savings account balance. Suppose that you have $1,000 on your savings account. Then you can charge up to certain percent, let's say 50% of that balance. So at any given moment, you can have a max credit card balance of $500. That is how I started myself over 20 years ago. I opened my first secured credit card, and after making consistent payments, I built my history and was able to qualify for unsecured credit card. Also, another strategy is to have a co-signer on a credit card application. It could be your parent or someone you know. And many college students build their credit history that way. Also, becoming an authorized user on someone else's card helps credit history too. I think it's less efficient though compared to having your own credit card. Again, many parents add their kids as authorized users and let them spend money up to a limit. Also, some credit bureaus offer building credit history with bills. For instance, Experian offers a program called Experian Boost. I'm not affiliated with them, just found it interesting. But it's a free service. It allows you to link your timely bill payments for utility and cell phone bills to their credit report. I see it being helpful for someone with no credit cards and just starting. In addition, Experian offers a free credit report and a FICO score upon sign up. And that'll be it for today. I hope I gave you some worthy strategies that can help you build your FICO score. Please give this video a like and share it if you think it can help someone. Also, subscribe to my channel for more actionable insight on personal finance in the future. As always, thank you so much for watching, and I'll see you next time. All the best!